Welcome back to another weekly episode. So this particular episode, we'll discuss about the SMID space, which is the small, mid, micro cap kind of a space that is beginning to see some bit of sell-off. So do watch the last two episodes also so that you get a link of what is being discussed. I remain bullish on the market, but bullish does not mean committing money. I'm not committing money because there is currently no structure available. There are a couple of sectors where you can hide, but those sectors also over time will kind of deliver returns that will align with the broader market. So since this video is more focused towards the SMID space, which is the small, mid and micro cap space, I won't discuss about SME because that is irrelevant for a lot of people. I'll also touch upon some economic policies that can come out of the US that can extend the recovery time, especially in the SMID space. So first I'll go through some basic charts. Again, a 50 DMA, a 200 DMA, comparative relative strength against something like Nifty 50. If you look at the small cap index, now you are seeing this particular stage breakdown happening and price is kind of sustaining below the 200 DMA. You look at small cap 50, the structure is the same. Mid cap 50, small cap 250, mid cap 100, mid cap 150, mid and small cap 400. You look at micro cap 250, hit a new low today. All these sectors in the market are facing selling pressure, especially after escaping when the correction began in the month of November, December. Now, if you look at certain sectors like IT, India Digital, I'll just open up the chart of India Digital also for you. Just let me find that particular index. This is India Digital. You take a look at pharma and healthcare. Now, these are the only four sectors where the selling pressure is not as much as you're seeing in other high beta sectors. And this is actually in tune with what happens whenever currency depreciates. I'll just take you back to the period of 2011 to 2013. This is where look at what pharma sector did. I'll also flip the chart and open up the IT sector, broadly look at what IT sector did during that particular phase between 2011 and 2013. Over a period of time, these were the only two sectors that performed well. And I think if my memory serves right, even auto sector was in some kind of a momentum phase in between. Yeah. So auto also in between, you were seeing momentum coming and going. So whenever currencies start depreciating, this is what usually happens, that defensive sectors kind of start working out. Even don't discount something like consumer durable. I'll just open up FMCG because that is where I have a lot of data. So 2011, 2013, see, look at what FMCG sector did, and consumption also, consumption sector. I'll again take you back to 2013 to 2011 to 2013. Again, consumption also did relatively well. Now, first coming to FMCG and consumption, when will you see FMCG and consumption starting to bottom out or start to do well? I think it would depend upon the kind of announcements that are made in the budget, which is now 1 week away. In case the government pushes, or in other words, government acts in an aggressive manner to boost consumption, then I think FMCG and consumption should also be put on your radar. But for the time being, it should be India Digital, IT, pharma, and healthcare. These sectors can also fall, but relatively these will fall less. Then there are a host of other sectors like banks, infra, metal. You take a look at PSU banks, then you take a look at realty. All these sectors currently have been beaten down a lot. So it's entirely possible. If you open up the chart of realty index, it's entirely possible, because there has been such kind of sharp sell-off. We go and retest 50 or 200 DMA, then over a period of time, we again kind of test out the lows. This is a possibility that can exist because we are sitting on a lot of gains that has played out since COVID lows, which is 2020. Now, directly I'll come to the point that Trump policy these days is doing the rounds as to something would be negative for India or other emerging markets. See, let me tell you, it's never that simple. Can Donald Trump announce policies that can hurt emerging market? Of course. But now if you look at the slide that will come in front of you, I've categorized it under 3 to 4 sub-points, that how Trump policies can affect and why emerging markets in general should be ready for more relative pain that can come about over a period of time. I'll open up the chart of emerging market. Look at what is happening in emerging market. Again, the kind of sell-off that has happened is in line with what India is facing. So it is not that India out of the blue is falling. No, it is not true. Emerging markets are falling, whereas developed markets are relatively holding up much well. In fact, a lot of those markets are at all-time high. So the first sub-segment would be the Trump trade policies and tariffs. Once I finish this section, then I would come back to the core of the video, which is when will the small mid micro cap stocks again start working. So the first subsection is the trade policies and tariffs. See, his administration has proposed that they'll be imposing tariffs on imports from countries such as Mexico, China, Canada, just to protect their own industries. Now, India is not a big exporter to the US, but whenever such policies come into the effect on emerging market, the impact is felt in India also. So how does India get impacted? So what usually happens is that such measures actually lead to the disruption of global supply chains. It also leads to increased costs for businesses and consumers in emerging markets. All right. So what generally happens is that there is a lot of uncertainty surrounding these policies, and this leads to a lot of volatility, which is what you're seeing in emerging market. The second important point I would tell you is about capital flows and currency volatility. See, what happens is that the strengthening of the US economies can be driven by the administration's agenda of America first. Now, this actually results in tighter global financial conditions. Now, what usually happens under this is that emerging markets actually face a sudden stop of capital inflows. And it also leads to significant net capital outflows, which leads to currency depreciation and increased borrowing cost. If you look at it, guys, this is what is happening in India and in emerging market. Because the administration is pushing for America First policy, the emerging markets are not getting the kind of inflows that we were getting in the last 3-4 years. In fact, we are seeing a lot of money moving out of India. I think in January alone, that number has hit about 60,000 crores or something. The third important point is under such policies, you face more inflationary pressure. See, whenever you're putting tariff, it actually leads to higher import prices, and that actually contributes to higher inflation more so in emerging economies. And of course, there are a couple of more points about investor sentiment and commodity price fluctuations that is not that relevant in the very short term. So my analysis at this point is that we as investors and traders need to brace for more time and price correction. What I feel that is my best guess as things would play out is that let's say we are in Jan and hopefully we don't get something ugly in the budget market over a period of time, let's say till about June, July, or maybe May, June, will remain in a downward to a sideways broad range, and then probably towards the second half we would get to see some kind of recovery coming in the market, because by then the administration in the US, the policies would be clear. It is still very early days. People are expecting a lot too soon, so let's see how things pan out. But one thing I'm clear is that recovery in the market will not be broad based so soon, which comes to the point that is the core point of the video. When will you see small mid micro caps start to trend the way they did between 2020 and 2023? Something like this kind of solid bullish phase. If I have to guess, I would tell you that we are still far away from such phases playing out in the market. And I'll give you a couple of reasons. See, you have to ask yourself, going back to history, when do small cap and mid cap stocks start to perform? Again, there are 3 sub points I'll state. I'll summarize in the slide that will come in front of you. The first is economic expansion. Whenever you are facing a situation where economy is poised for growth, this is where small cap stocks actually start doing very well and they outperform large caps by a huge margin. The second is increased consumer spending. And that is why I tell you this budget is important. If you see clear signs of government pushing for a lot of consumption, maybe through tax cuts, which is, I don't know whether we are ever going to get anything in our favor, but let's hope. Or some policy comes out that the government starts pushing for increased consumption, then I think this chart can turn very quickly. So this is the first major point. The second is lower interest rates. See, whenever you have affordable financing, you have higher risk appetite in the economy. So low interest rates reduce the borrowing cost. This actually allows small cap companies to finance expansion and they can run their operations more easily. When it comes to higher risk appetite, in low risk environments, investors and these small cap companies, they often seek capital intensive policies within their own sectors and sub industry, which means they focus on spending a lot, on researching a lot, and many of these companies then transition into a mid or large cap company in the next 15-20 years. It can only happen when we have point number one, an economy that is in the growth phase. Point number two, low interest rates. The third and important point is the domestic economic strength. Now, what do I mean by domestic economic strength? It means an economy where impact of global events is relatively less. This is where small caps, often you will see whenever there is a recession and the recovery comes, the first stocks to run are the small cap stocks. Why? Because it has already been discounted by the market that the worst is over at the global level and now things will improve. That is why you look at 2009 recovery, you look at COVID recovery, you look at 2001-2, the dot-com bubble recovery, small, mid, micro cap stocks were the first stocks to start running. So this is an environment for it. All right. And obviously sentiment plays a huge role. What do I mean by sentiment? Currently, if you look in our market inward, the sentiment is just not great. And whenever the sentiment is not great, the recovery process actually prolongs a lot. So I would tell you that in the next few months, is it possible that due to some global market event, we somewhere come back and test out this range? It could be. It is possible. But until and unless we have a situation where interest rates are lower, or we are again seeing an economy that is moving towards a growth and expansion phase, or the overall sentiment improves, it's very unlikely that the smooth trending phase of small mid micro cap stocks is going to be back. I think a lot of people are caught up in this phase between 2020 and 2024, and that will turn out to be a huge mistake in 2025. You have to adapt with changing times. And I definitely feel that if such things persist, which means the administration in the US seriously pursues the policy of America first, if we see inflationary pressures returning to emerging market, which is what will happen if they do it, then the low interest rate environment plus the economic expansion environment is not going to come back so soon. If these 2 points won't come back, there is no way the SMID space is going to move up drastically fast. I can be completely wrong, but when I listen to the interviews of most of the mutual fund managers who remain super bullish on Indian economy, they are factoring in too many positives. Too many things right now have to fall in place for a momentum oriented move coming back to the SMID space. The thing I'll watch is the budget. I would like to see what the government does in terms of increasing the consumption pattern or power in the economy. If they succeed, then yes, towards the second half, the SMID space will again start doing well. Else, based on long-term relative strength structures, if you look at the chart now, since elections, the mid-cap space is relatively flat to Nifty 50. There is a message here, guys. The message is whenever you as an investor is betting on the mid and small cap space, and you see over a period of 6 months, 7 months, the space has given you relative negative return, it is actually much more negative than what the index is saying. Because had you invested in any stock in June 2024 or July 2024, that stock would be down at least 20-25%. So the risk of even a flat relative strength on an index is not that much as compared to the stocks you actually own at the portfolio level during the same phase have at least fallen 25-30%. So the call here, if you look at microcap space, which had the best relative strength, that is also starting to go flat. This is a relative flat relative strength that was there. The value was 163 during election period. It was 165. And while the microcap index has stayed at the same level, let's say this was month of August, we have fallen just about 9%. Stocks are actually down 30%. All right. So the sentiment in the market, which was one of the points I discussed, is being so beaten down that it's going to take some time for things to repair. And the last point I'll make, which I discussed in the last week's video also, is the dollar index. The dollar index is coming out, I think, of a 3-year range. That range was between 107 and 100. So I'll just draw the range so that it's easily visible for you if you're watching this on a mobile device. So this is a range where dollar index was between 100 and 106.7. It's currently right at the top end of the range. If we are going to see some retracement, you can expect some rally coming in the emerging market, which will be short-lived. But then, if this is what is going to happen for the rest of the year, it's going to get very difficult unless and until Indian government pushes for a lot of things in budget. It's going to be very difficult for the small mid micro cap space to outperform by a huge margin. FIIs are also exiting India because in dollar terms they are getting about 5-6%. While in the US itself, they're getting huge return in equities. Look at what Nasdaq is doing. Look at independent stocks within Nasdaq. And in general, the debt market is also not delivering returns that do not seem attractive when you consider the risks that can play out when they're investing in a country like India or any other emerging market. Now, coming to the budget, 1 week before budget, I think there'll be some of you who would try and attempt to trade. Let's say the budget comes out good and you feel a retracement can happen. You would try to capture this. I think you should stay away from it. On Instagram, a couple of days back, I had updated the major and minor pivots for Nifty. If you want to take a trade, then go through the chart that I had posted there, because that is a chart that will show you when you need to be aggressive in terms of position size. As of now, the major pivot in the market is somewhere around 25,000. I won't even consider this as a major pivot. This is actually a minor pivot. So I don't think the time is right for you to even play a budget kind of a trade. Be patient. Currently, the market, the sentiment, everything is not that great. And you just have to be patient in this phase. Let it play out. Let's see what happens. And let's hope that the budget doesn't turn out to be negative for the stock market. It can be great for the economy. It can be negative for the market. If capital gain tax or something of that sort again gets, tinkered with, I don't think the market is going to take it so kindly. And even the corporate tax, if that is also increased because the government needs money for a lot of things, we all know what is going on. Even if corporate rates are tinkered with, I don't think that's going to go down so well. So I would personally not want to trade a lot in the next week. Let the budget play out. Couple of days after the budget, you have the Fed policy, RBI meet. Let these events go out. The market is not going anywhere. And as it is, I'm sure any trade that you're putting on the long side, you're taking losses. Sometimes sitting on the sidelines is also the greatest trade you can place. So be patient. Let's see how things play out. Next week's update, I think I'll give out on a Sunday because budget is on Saturday. So there's no point making a video then. See you guys. Take care and be safe.